And we are live. Good evening, everyone. Tonight, we will be discussing a recent video clip that has resurfaced where Bloomberg basically said that the housing crisis of 2008, it wasn't caused because of fraudulent mortgages, predatory lending. It was actually caused by Congress, the government, forcing banks to loan money to poor people because of redlining. And this is a talking point that you consistently hear coming from conservatives and Republicans, basically saying that somehow the Community Reinvestment Act and other pieces of legislation force these banks to over leverage themselves. And it's just flat out laughable and it's disgusting. If you actually sit back and you study the Federal Reserve banking system, you will understand that this is what is known as the boom and bust cycle. This continues to keep happening over and over again, and it will keep happening because the problem isn't more regulation, it isn't oversight, it isn't capitalism. It's the way that the economy is structured. And once you understand Keynesian economics and you understand that we live in a debt-based society, the only way that the economy can grow is to expand debt. And that's it. Nothing more and nothing less. So it's laughable to hear him say these things. And this is why I encourage a lot of you guys to go out and watch the documentary Money is Debt, because you will understand why this keeps happening. Also go out and read the book The Creature from Jekyll Island, because this is extremely important. Now, the other guy that you see with the thumbnail that's flashing across your screen is Steve Mnuchin, who is currently the Treasury Secretary for your president, Donald Trump. And he oversaw one of the largest robo signings, basically the foreclosure gate that was happening back in 2009 and 2010. So with that being said, as you guys come in, please hit one if you can see and hear me clearly. Like this video, share this video. If you're not subscribed to the channel, please subscribe, hit the notification bell. Also, to make sure that you're always notified when I go live or make a video, please join my mailing list. Simply enter in your name, your email address, and I will always be able to notify you. If you want to be able to contact me, please follow me on Instagram and just send me a direct message, and therefore you and I will be able to communicate via DM on Instagram. And if you want to support this content financially, a link to my PayPal will be in the description below. And I've seen a donation come in. Thank you so much, Charles Jr. With that being said, I want to flip the screen over now so everyone can see and hear me nice and clearly. That's good. So these are two movies that I really think that you need to take the time out to actually go and watch so that you can understand what's going on. You know, I like to keep things simple. I don't like to overcomplicate stuff. Too Big to Fail is a fantastic movie documenting what exactly happened with the economy and with the banks, and how the banks that were too big to fail then, they took the bailout money and they just became bigger. They basically gobbled up smaller banks and became bigger. So now when the next crisis happens, if they were too big to fail then, they're going to be too big to fail now. And this country has a history of bailing out banks, and I'm going to highlight that for you. So when you hear people saying, oh, no one was able to see this coming, no, they've seen this coming because this happened during the savings and loans crisis back in the 80s. They've bailed out First Pennsylvania Bank, and they've bailed out One Continental Illinois. So I'm going to highlight all of that stuff. Also, to understand the securitization aspect of the whole mortgage-backed securities, CDO, CDO squared, go and look at The Big Short. This is a really, really good movie. I encourage a lot of you guys to go out and watch it. Now, with that being said, let's get into the juicy stuff now. And this is from 2008. You can see the date here. It says 2008, September 17th. And this is the conversation. So let's play this. Give me 1 second. Hold on. I got to turn the volume on. There we go, and we're good to go. So,
King. You've made some reference to the elements that led to where we are today. Could you go a little bit deeper and tell us from your perspective, how did we get here? What are the root causes of the crisis?
You can go back. I would say it probably all started back when there was a lot of pressure on banks to make loans to everyone. Redlining, if you remember, was the term where banks took whole neighborhoods and said, people in these neighborhoods are poor, they're not going to be able to pay off their mortgages, tell them your salesmen don't go into those areas. And then Congress got involved, as local elected officials as well, and said, oh, that's not fair, these people should be able to get credit. And once you started pushing in that direction, banks started making more and more loans where the credit of the person buying the house wasn't as good as you would like. Now, it's not so bad when the market for houses keeps going up, because the nice thing about making a mortgage loan is it's very secure. After all, if the borrower defaults, you simply sell the house and you have something that's worth more than the value of the mortgage. That assumes that real estate prices never go down, and we just discovered that they could. The way a bank works in making mortgages, it's exactly the same way as an insurance company works. You assume that a handful of people will default, but most people won't, and you share the pain with other.
So the premise and the context and how he's framing this conversation is just fraudulent from top to bottom. Number one, as a bank, you should have underwriting standards and understanding how markets work. The free market will punish you if you loan money to people who do not deserve the money. See, this was a systemic failure across the board, from the top, as far as government regulation is concerned, as far as regulators are concerned, and as far as banks are concerned. But they did this because they knew we have a history of bailing out the banks, and they didn't care about the end result. All they cared about was originating as many mortgages as they possibly could so that they can actually get the fees and then securitize it and then sell it in the open market and make a whole bunch of commissions. That's all it was about from top to bottom, 100%. Now, I want to talk about this as far as black people are concerned, because Wells Fargo is a bank that keeps finding itself in trouble as far as being fined and just doing things that are predatory. So it says banks accused of pushing mortgage deals on blacks. This is from June 6, 2009. It says, as she describes it, Beth Jacobson and her fellow loan officers at Wells Fargo Bank rode the stagecoach from hell for a decade, systemically singling out blacks in Baltimore and suburban Maryland for high interest subprime mortgages. Now, I started highlighting a paragraph here, but as I read this article more and more, I said, I'm going to stop highlighting stuff. This entire article is extremely important because you will understand how they are systemically and particularly going after low-income, poor black people on purpose and giving them bad loans. It says these loans, Baltimore officials have claimed in a federal lawsuit against Wells Fargo, tipped hundreds of homeowners into foreclosure and cost the city tens of millions of dollars in taxes and city services. Wells Fargo, Ms. Jacobson said in an interview, saw the black community as a fertile ground for subprime mortgages. As working class blacks were hungry to be a part of the nation's homeowning mania, loan officers, she said, pushed customers who could have qualified for prime loans into subprime mortgages. Another loan officer stated in an affidavit filed last week, the employees have referred to blacks as mud people and to subprime lending as ghetto loans. I want to repeat that paragraph for you again. It says Wells Fargo, Ms. Jacobson said in an interview, saw the black community as fertile ground for subprime mortgages as working class blacks were hungry to be a part of the nation's home owning mania. Loan officers, she said, pushed customers who could have qualified for prime loans into subprime mortgages. Another loan officer stated in an affidavit filed last week that employees had referred to blacks as mud people and to subprime lending as ghetto loans. Think about that for a second. I really want you to think about that. Now, I know some of you may not be that technical. You may not get this. So what I'm going to do is I'm going to flip over to the iPad and I'm going to show you the criteria for prime, for super prime, for deep prime, and for subprime. Give me 1 second. Let's pull that up so that we can understand and have a clear understanding that this had nothing to do with Congress forcing them to loan money to black people. It was the incentives. It was the incentives to particularly go after poor black people. And when you understand this, this is why financial literacy is important. Because right now I just flipped it over to my iPad and I want to pull this up and show you. Right here, this is what is known as super prime. Super prime is people who they have a 780 to 850 credit score, right? These are people who actually, they have high credit. They're going to pay it back. What they were doing is they were loaning to people down here in the subprime, 500, 600 credit score, and in deep prime. And they were taking black people who actually qualified for prime, and they were putting them into subprime. I want to repeat that for you again. There were black people who actually qualified for prime loans. That means that their credit score was between a 661 and a 780. And they were then forcing them into subprime mortgages. Now, understand subprime mortgages, they carry a higher interest rate, and we're going to get to that in a second. So that means over the lifetime of that mortgage, you're going to probably pay $100,000 to $200,000 more. This is why financial literacy is important. Because, see, it's not like they're not locking you out the market. They'll let you come in the market, but they're going to bring you into the market in a predatory fashion, which is going to be detrimental to you. And because a lot of our people, we lack financial literacy, we just want the American dream. But a lot of us, we don't realize that the American dream, in some instances, can become the American nightmare. Home ownership isn't for everyone. And we're going to get to that in a second. But they were referring to you as mud people and ghetto loans because they were purposely going after people who they knew shouldn't have owned a home in the first place. Think about that. As I said, I was highlighting. So when Bloomberg says that Congress was forcing them, Congress wasn't forcing them. And you're going to see that in a second. This article, let me put this in the chat for you guys so you can go and read this later on, because this is really, really important that you take the time out to educate yourself about what's actually going on. Right? It says, Wells Fargo, Ms. Jacobson said in an interview, so the black community, I read that part already, right? So here we go. It says, we just went right after them, said Ms. Jacobson, who is white, and says she was once the bank's top producing subprime loan officer nationally. Wells Fargo Mortgage had an emerging market unit that specifically targeted black churches because it figured church leaders had a lot of influence and could convince congregants to take out subprime loans. They were going after the church and getting the black pastor to give out these loans to black people. Think about that for a second. Your black church. And I got to flip it around. Sorry, guys. Let me do that. I keep doing this. I have to get used to this. Flip this around. I want to read that passage to you again. It says, we just went right after them, said Ms. Jacobson, who is white, and says she was once the bank's top producing subprime loan officer nationally. Wells Fargo Mortgage had an emerging markets unit that specifically targeted black churches because it figured church leaders had a lot of influence and could convince congregants to take out subprime loans. That's not Congress forcing you to make those loans. That's not the government putting pressure on you to do that. That's you creating a product to go after unsophisticated people, unassuming people who don't have any business owning a home. That's what the problem is. Now think about your church. I want you to think, for those of you who are in the black church, I want you to think about that for a second. This is the question that you got to ask yourself. It says Miss Jacobson's account and that of the other loan officer who gave an affidavit, Tony Pascal, both of whom have left Wells Fargo, provide the first detailed accusations of deliberate racial steering into subprimes by one of the nation's top banks. The toll taken by such policies, Baltimore officials argue, is terrible. Data released by the city as part of the suit last week show that more than half of the properties subject to foreclosure on a Wells Fargo loan from 2005 to 2008 now stand vacant, and 71% of those are in predominantly black neighborhoods. Because that goes back to the securitization of mortgages. And we're going to get to mortgage-backed securities and get back into derivatives of how these banks, they didn't care about whether or not you had quality credit. What they cared about, the most important thing that they wanted to do was they wanted to originate the mortgage. Because see, once they originate the mortgage, they can then go and sell it to another bank. So they didn't care if your credit was good or not, because once they originate the mortgage, they get the fees. See, the banks win across the board because, number one, follow me here. This is important. They create money out of thin air. When you go and get that mortgage, that money doesn't exist. The bank doesn't have any reserves. So when you go and you sign your name on a dotted line, you just created that $300,000 out of thin air. But the bank benefits immediately because they get origination fees for you getting that mortgage. And then what they do is they then go and sell it in the market and they generate another commission on top of that. Or what they do is they'll securitize it and they'll put it in a whole tranche. And then they'll go and they'll sell it in illiquid markets and they'll call it a mortgage-backed security. So every month when you make your payment, that money is going to investors who actually were purchasing the mortgage-backed securities. But see, the problem with that is that once you stop paying, the interest that's yielding on that mortgage-backed security doesn't get paid out. Now, it would be okay because the bank can foreclose and get that property back. But the problem is, as more and more people started foreclosing, the property value started to plummet. But the bank didn't care. You know why? Because they had something known as a CDS, a credit default swap, which was an insurance policy on you not paying the mortgage. So think about this now. So now they also are banking on the fact that even if you don't pay, they're going to go to AIG and call that insurance policy. So now AIG says, hey, no problem, because AIG is saying most people pay their mortgage. AIG doesn't know that Wells Fargo is loaning to subprime people. They're thinking that they're loaning to good people because, hey, they're a bank, right? They have PhDs in finance and economics. They're not going to loan money to Susan and Rhonda and Rebecca and these people with credit scores in the 500s. Why would they do that? So now AIG gets slick. They don't have the collateral to actually pay in the event that the person defaults. So then they go out and they get insurance on the insurance. So essentially, these banks are creating more and more money out of thin air. Now, to give you an idea, I always like to highlight this because this is extremely important. So let's go back to the iPad. Let's flip this over. This goes back to when I talk about fractional reserve banking. Banks don't have reserves. They create money out of thin air. Money is debt. So what happens now, let's pull up the highlighter really quick. When you deposit that $100 in Wells Fargo says, hey, Susan doesn't come take her money out often. So what we're going to do, because this is legal, they can loan up to 90% of the reserves they have on hand. So what they say is, hey, check this out. I'm only going to hold $20 of Susan's money, and I'm going to loan out $80 of Susan's money. So they just created $80 out of thin air, out of your money. Now this $80 ends up in Chase Bank. And Chase does the same thing. Chase says, you know what? Robert's not going to come get his $80 right away. So we're only going to hold $16 of Robert's money, but we're going to loan out $64. Now, this process keeps happening over and over and over and over again. And we're here where it says loaned out. They end up creating $346.31 out of thin air. That's bank loans. I mean, that's mortgage loans. That's auto loans. That's credit cards that people are paying interest on. And then what they do is they then go and they securitize those loans. So they keep making all of these products on top of products on top of products. And they don't care. Because now what they're saying is, even if you default, we have insurance with AIG. But see, AIG is thinking like a bank now, because AIG is saying, hey, people aren't going to default on their mortgages, or not that much, right? Maybe 10%. So they don't have enough reserves, which creates deflation, money destruction. And they know moral hazard, the government's going to step in and bail them out. Why? Because they are too big to fail. Now, I want to get back to the article, because when I was reading this article, it was just getting me upset. I just couldn't believe what I was reading. But I want you to understand that, guys, it's much more complicated than this. Yes, it is. But I'm giving you the basic context, the template of what's going on. If you and I tried to create money out of thin air, we would go to jail. If you and I loaned out money that we did not have, we would be running a Ponzi scheme. If we took investors' money, new investors to pay off old investors, we would be running a Ponzi scheme. But if they do it, this is legal for them to do it. It says, I don't want to read that part. It says, we have worked extremely hard to make home ownership possible for more African-American borrowers, wrote Kevin Wake, a spokesman for Wells Fargo Home Mortgage. We absolutely do not tolerate team members treating our customers or others disrespectfully or unfairly, or who violate our ethics and lending practices. Excuse me. We don't need this right here. Here we go. This one right here. This is the part that really got me. It says, at the heart of such charges is reverse redlining, specifically marketing the most expensive and onerous loan products to black customers. At the heart of such charges is reverse redlining, specifically marketing the most expensive and onerous loan products to black customers. So when I hear people say, oh, they won't loan money to black people, no, they'll loan money to you. They're just going to give it to you at a higher rate. They're going to give you one of the worst products, not one of the good products. This is where financial literacy comes into play. Because people like to call me, hold on, let me read off before I go on one of my rants. It says, the New York Times, in a recent analysis of mortgage lending in New York City, where I live at, found that black households making more than $68,000 a year were nearly 5 times as likely to hold high interest subprime mortgages as whites, similar or even lower incomes. The disparity was greater for Wells Fargo borrowers, as 2% of whites in that income group hold subprime loans and 16.1% of blacks. It says, we've known that African Americans and Latinos are getting subprime loans, while whites of the same credit profile are getting the lower cost loans, said Eric Halperin, director of Washington office of the Center for Responsible Lending. The question has been why, and the gory details of this complaint may provide an answer. I want you to think about that. This person is middle class. They're making $68,000 a year, and they're holding a high interest subprime mortgage, while white people who have similar income or lower income or even a lower credit profile get better loans. I want you to think about that. I really want you to think about that for a second and put that into context. Now, a lot of you're going to come on here because you're going to call me a flip-flopper. And you're going to say, oh, you're a bootstrapper. You believe in doing for self. I do believe in doing for self. But I believe in doing for self while being educated. This is why financial literacy comes into play. Because now understand, while I'm doing for self, if I see that a person is trying to give me a predatory loan or give me a loan that I know I don't have no business getting, guess what? I'm not taking that loan. Because I understand home ownership isn't for everyone. This is why financial literacy is important. This is why it's important to have financial literacy. Guys, I'm not saying that it's all peaches and roses, and I'm not telling you that bootstrapping and doing for self is going to close the racial wealth gap. You will never hear me say something foolish like that. I understand that there are structural things in place that make it difficult for you. But if you have financial literacy, you won't find yourself in this position. I'm not taking out a mortgage paying me 8% if I know rates are 3%. Let me repeat that again for those of you in the back. Oh, you're a bootstrapper. You believe in doing for self. Yes. But by being financially literate, I will be literate and not take out a mortgage with an interest rate at 8%. Because when you go to a mortgage calculator, you don't have to be a rocket scientist to figure this out. See, I believe in giving you the facts. If I take out a $165,000 mortgage and I'm paying 3.92% and over 30 years, my monthly payments is $780. Here we go. If I bump that rate up to 8%, that mortgage payment goes from $780 to $1,318. So guess what I'm going to do? I'm not taking out that mortgage because I'm financially literate. I'm not saying that this is going to stop racism, white supremacy, I don't say that. You never hear me say that crazy stuff. I'm not one of those people who say that. But I'm telling you is that if you have literacy financially and you understand that this payment almost doubled on me because of the interest rate is high, you don't take that mortgage. That's what literacy does for you. Because look at the difference. The total cost of a mortgage for 30 years at 8% is $474,531. If I drop it to 3%, it's $280,000. That's a $200,000 difference over the life of the mortgage. That's where financial literacy comes into play. If you're buying a home, that's where financial literacy comes into play. Now, I want to finish reading this article because the more I read this article, the more upset I became over and over again. Skip here. It says in 2001, he states in his affidavit, Wells Fargo created a unit in the mid-Atlantic region to push expensive refinancing loans on black customers, particularly those living in Baltimore, Southeast Washington, and Prince George's County, Maryland. They referred to subprime loans made in minority communities as ghetto loans and minority customers as those people have bad credit. Those people don't pay their bills. And mud people, Mr. Pascal said in his affidavit. He said a bank office in Silver Spring, Maryland had an affinity group marketing section which hired blacks to call on African American churches. They were using the church to sell black people subprime loans. They were using the church to sell black people subprime loans. I want you to think about that. I want you to think about that. I want you to think about that. Using your church to sell you subprime. They set up a marketing department. So when Bloomberg says that it was Congress forcing them to make these loans, doesn't sound like Congress is forcing them to make these loans to me. It sounds like they created a marketing division to loan people to make loans to people who had no business borrowing money in the first place. I want you to think about that for a second. I want you to use your brain and just see that. They created a marketing division to go after one specific community of people. It says the company put bounties on minority borrowers, Mr. Pascal said. By this, I mean that the loan officers received cash incentives to aggressively market subprime loans in minority communities. I'm going to read that for you again. It says the company put bounties on minority borrowers, Mr. Pascal said. By this, I mean that the loan officers received cash incentives to aggressively market subprime loans in minority communities. Think about that. Nobody's forcing them to make these loans. They're making these loans because they know they can go sell it on the market and they can get fees. And they can securitize it. And they could create mortgage-backed securities and CDOs and CDO squares and get paid bonuses. They were getting cash incentives to do this. And in a free market, see, this goes back to, this is not capitalism. This is cronyism, because these banks know that they're going to get bailed out. They also know that they're insured to a certain degree, but they didn't bank on the insurance fund being bankrupt. This is known as moral hazard. See, in the free market, if a bank makes a loan, they make too many bad loans and they fail, then they fail. That's what you have bankruptcy for. That's how markets are supposed to operate. The market operates where when you make bad decisions, you fail. But when you become too big to fail, like Alan Greenspan said, then you are too big to exist. If you're too big to fail, then you're too big to exist. This is the problem. This is why you need free markets. But see, everyone knew this. And here's the funny thing. Not only do they rape you with fees, not only do they make the money by originating the loans and then going out and creating securities, but then they get bailed out from the taxpayer on top of that. Block this person. Boop. Then they get bailed out by the taxpayer. And we know the government doesn't have any money. So the Federal Reserve just prints money and bails these banks out. Creates more money out of thin air. So we get double taxed. We pay our taxes and then we get taxed through inflation. Now, someone says no oversight for the overseer. Well, here's the problem. Look who the overseers are. Henry Paulson. The people who are supposed to be watching the inmates, they actually come from the same place. See, there's a revolving door between Goldman Sachs, Lehman Brothers at the time before they collapsed. All of these banks that you see, Henry Paulson, he comes from Goldman Sachs. So get this straight. See, when you're a three-dimensional thinker, you don't fall for the conservative talking points because you're intelligent. The very guy who works in the bank, they go and hire what is known as lobbyists. And they go get people to lobby on behalf of the banking industry to, come on, man, let some of these regulations up. And then now, the guy, Henry Paulson, who works at Goldman Sachs, he then goes and works in the public sector for the government. So he comes from the very place that created the problem. He then goes and works in the place that's supposed to solve the problem. And then he deregulates the industry, bails out all of the banks. They buy up their competitors, pass a bunch of regulation to make it hard for people to compete. And then he goes from being in the treasury, he goes back into the private sector. That's part of the problem. Oh, don't believe me? You think I'm cherry picking because I just picked Hank Paulson? Oh, well, let's look at Timothy Geithner. He goes from the Federal Reserve Bank of New York. Then he becomes the 75th Treasury Secretary? Right? And then he goes in there, manages the banks, the inmates running the asylum. And then he goes from the public sector, and now he's working in private equity. So the very people who are supposed to be regulating the banks, the government, are the people from the banks. And now Steve Mnuchin, the guy who I see who had flashing across the screen, he goes from running One West, and you're going to see this in a second. He then goes and buys IndyMac, and the government gives him guarantees on the mortgages that he's taken over, the bad mortgages, and then he starts doing robo-signing, where they were foreclosing on people's houses, and they didn't even have the right to foreclose. That's not the government, because the government is the banks and the banks is the government. They're the same people. See, when you have intelligence, you know, it's not, it's Congress, it's poor people. No, they're all the same people. They're all the same people. They're all in this together. It's a cartel. And what do most cartels do? They rig the market, they block out competition. John D. Rockefeller said, competition is a sin. This isn't capitalism. This isn't about competition. This is about locking you out so you can't compete, or making regulations so onerous that you can't go start a bank and compete. How much money you think it costs to start a bank, just from the regulation standpoint? So it creates a barrier to entry. And then the banks that were too big to fail, they just go and get bigger. But you have to be intelligent to see this. It says both loan officers said the bank had given bonuses to loan officers who referred borrowers who should have qualified for a prime loan to the subprime division. Ms. Jacobson said that she made $700,000 one year and that the company flew her and the other subprime officers to resorts across the country. I used to joke that I'll pay for your kids to go to private school if you give me clients, Ms. Jacobson said in the interview. So these are people who qualify for prime loans. They have good credit. And they're forcing them into subprime. Abello Gino said, what candidates the bankers wouldn't like? Bernie? They're all the same. Guys, they're all the same. This is not about Republican versus Democrat. See, once you get out of the whole left-right paradigm, right? Once you get out of the whole idea of Republican versus Democrat, and you begin to understand that it's a systemic problem because money is debt. Money is debt. It's not about the Republicans versus the Democrats. It's about how your money is created. And thank you for the donation. And thank you for the donation to Blackboard. When you understand that, when you look at this chart that I constantly show you guys, you understand there's $74 trillion of debt in the system. There's only $1.6 trillion of actual cash in the banking system because money is debt and the economy can only grow by people going into debt. Right here. U.S. household debt hits a record high of $14.15 trillion. Guys, I don't come up here and speculate. I don't come up here and just, guess randomly, something that I watched a video on. This is from their own mouth. It says total U.S. household debt reached a record $14.15 trillion at the end of the year after increasing by $193 billion, or 1.4% in the fourth quarter of 2019, according to the Fed's quarterly report on household debt and credit. The report, based on a nationally representative sample of individual and household level debt and credit records drawn from analyzed Equifax credit data, noted that total household debt is now nominally 1.5 trillion higher than the pre-recession peak of 12.68 trillion in the third quarter of 2008. There's more household debt today than pre-recession level. There's more household debt than pre-recession levels today. Look at that. See it for what it is. It's in your face. I'm going to read a little bit more. Give me 1 second. Loan officers employed other methods to steer clients into subprime loans, according to the affidavits. Some officers told the underwriting department that their clients, even those with good credit scores, had not wanted to provide income documentation. This is known as ninja loans. No income, no job, no assets. They didn't have to verify anything. By doing this, the loan flipped from prime to subprime. Ms. Jacobson, but there was no need for that. Many of these clients had W-2s. Other times, she said loan officers cut and pasted credit reports from one application onto the application of another customer. These practices took a great toll on customers. For a homeowner taking out a $165,000 mortgage, a difference between 3 percentage points in the loan rate, a typical spread between conventional and subprime loans, adds more than $100,000 in interest payments. And I just showed you that. This is where financial literacy comes into play, because if you're literate, you're not going to take out that loan. You're just not. Now, again, I want to show you the toll that it took on people so that we can now get into Steve Mnuchin, who's now the Treasury Secretary. This is the game that they play.
Things that are going to my friends and things.
Karen Lucas has owned this house near Cleveland, Ohio for 35 years. Tomorrow, the Cuyahoga County Sheriff's Office plans to serve her with foreclosure papers and force her to move.
we had to refinance because of my husband's company being purchased by another company. So we refinanced, and then he did lose his job from that company.
Like almost 70,000 other families in the Cleveland area over the last 5 years, Lucas and her husband were not able to keep up with the ballooning payments of their subprime mortgage.
And this is the kitchen that we were going to renovate.
Lucas has been fighting a 4-year legal battle to keep her house. She has filed a final appeal with the court in an effort to hold off foreclosure for another 30 days. With hours to go, there is no word from the court.
I've done my crying. I've made my peace, and I've put it in God's hands.
Cleveland, Ohio was one of America's great industrial cities of the 20th century, a heavy manufacturing town nestled along the banks of Lake Erie. Ohio has lost more than 200,000 manufacturers.
Now, follow me here. An adjustable rate mortgage is basically where, again, remember, these banks are originating mortgages, and they'll give you a very low teaser rate at the beginning where you can afford the payments. And then in the next 3 to 5 to 7 years, the interest rate then jumps to the point where now, instead of you paying 2 or 3 or 4 or 5%, now you're paying 8, 9, in some cases 10% on that mortgage. But the bank doesn't care because, see, they've already originated the loan and they've already sold it to someone else. And watch what happens next, because this gets to the next point. This is why financial literacy is important. And there's 225 of you watching. Guys, please hit the like button. It helps the content rank in the search engines. Thank you.
Manufacturing jobs in the last 10 years, and the median income in the state has declined by 10%.
It actually sold it somewhere close to 70,000.
In the late 90s, subprime mortgage lenders set up shop in the Cleveland area. Many people refinanced their mortgages to take advantage of historically low interest rates, and their problems began. Community activist Barbara Anderson.
Sometimes the house would be flipped to another company, and we wouldn't even know. We'd still be sending it to the old company. And then we'd get a call that would say, hey, wait a minute, you didn't pay us. And we'd say, who are you? They said, well, we're your new servicers.
Subprime loans are higher interest rate loans that lend.
So now follow me here, right? So now this is what they're doing, right? So now you're about to hear her talk about how, in one case, she gets a mortgage from, let's say, Chase, Wells Fargo, whoever. They then go and sell her mortgage to another company. Now she's making the payments. You're going to hear this come up in, I think, either this video or a later video. The person is making their payments. The problem is who she's paying, they don't own the mortgage anymore. So now you get a call or you get a letter in the mail 60, 90 days later, and then they say, hey, listen, you ain't pay your mortgage. And you're saying to yourself, no, that's not right. I paid my mortgage. And now you're in foreclosure, even though you've been paying your mortgage, because you were paying your mortgage to the wrong company. Think about how gangster that is and how fraudulent that is. That's not Congress. That's not these greedy poor people trying to get a house. That's greedy bankers committing fraud. And and they actually, during the investigation, they were able to get the bankers' emails from Goldman Sachs, and they were laughing about underwriting these type of mortgages or selling these type of, not underwriting. They were laughing about selling their investors the garbage mortgage-backed securities. They were laughing about selling them garbage mortgage-backed securities because they knew that the people who were taking out these mortgages, they couldn't afford to pay the adjustable rate mortgage back.
Subprime loans are higher interest rate loans that lenders offer to buyers who do not qualify for lower prime rate loans. The loans are often sold multiple times among banks, making it difficult for borrowers to keep track of who owns their loan. Anderson's loan agreement contained clauses that allowed her loan servicer to add on additional fees.
Future late fees. I don't know what that is, but that was tacked on there. And then other fees. Those were never outlined. That was tacked on there.
Her initial 7% loan was now close to 20%. With the help of a community organization that works to get...
They said her 7%. Now, mind you, this video is 11 years old, guys. But I wanted to just show you something. I wanted to pull it up on a calculator. She was paying 7%. So let's say you're paying 7% on $165,000. Right? It went from 7 to what they said, 20? Hold on, let me replay that real quick. What did they say the loan was?
Get people close to 20%.
Close to 20%. So now her loan explodes to 20%. Look at this. That's crazy. That's crazy. Even let's say there's a poor place and you're paying 6. That's crazy. 20%. Do you understand how crazy that is on a $65,000 mortgage at 20%? That's $408,000. Do you understand how crazy that is? That's why financial literacy is important. I'm not saying that it's going to save you. I'm not saying that it's going to make you rich. I'm not saying it's going to close the racial wealth gap. So please don't come on that video and and say any of this foolishness to me. Okay? I'm not saying any of those things. What I'm saying to you is that if you're financially literate, there's no way in hell you should be taking out a mortgage at 7% and not reading the fine print and having it jump to 20% on you. There is some level of personal responsibility. Yes, this is predatory lending. Yes, they're going after a demographic of people who don't know any better. Well, this is why you need to know better. Because they're robbing these people blind. They're robbing these people blind. This is not this had nothing to do with poor people. This had everything to do with the banks who should have known better. You have no business loaning money to people who you know cannot pay it back. But it's the incentive. It's the incentive mechanism. We're going to get to that in a second.
With the help of a community organization that works to get people out of bad loans, the Andersons refinanced their loan at a fixed rate of 5 3/4% with a bank that does not sell its loans. Barbara Anderson is one of the lucky ones. Cuyahoga County expects more than 20,000 foreclosures in the next year. On the day the sheriff is scheduled to serve foreclosure papers, Karen Lucas has no word from the court about her appeal. As she sits down to talk with us, there is a knock at the door.
Foreclosures, and they went after the people that got the loans, not the lenders.
How you doing, Miss Lewis?
No.
Lucas? Are you aware of what's going on? The officer asks us to move back as he serves Lucas with the foreclosure papers. She must vacate the premises immediately. She goes inside to work out the details of her move. Later, she comes out to talk with us one last time, holding the judge's decision on her failed appeal.
This is not justice. They are protecting their own, and I am tired of it.
It is a scene that will be duplicated thousands of times in cities across the U.S. over the next several years as the effect of the subprime loan crisis ripples across the country. Families uprooted, lives altered, memories left behind.
So now let's get to the person or one of the people who oversaw a company at the time, One West, that was actually doing these foreclosures. Now, I want to give you the definition of what is known as robo-signing, all right? Because there was something called a robo-signing crisis. It says a robo-signer refers to an employee of a mortgage servicing company that signs paperwork such as foreclosure documents robotically without reviewing them. Rather than actually reviewing the individual details of each case, robo-signers assume the paperwork to be correct and sign it automatically. This is important. I want to give you the definition first, because now I want to introduce you to someone named Steve Mnuchin. Now, here we go, right here. This is good old Steve Mnuchin. And we were going to see what he did, right? Because he was one of the people who helped save the economy. Trump said he did a fine job. A fine job out of robbing Americans, but we'll get to that in a second.
Trump's pick for Treasury Secretary preparing for a big fight. Steve Mnuchin facing his confirmation hearing tomorrow. Democrats want to focus on his record during the housing crisis. Critics say he made a fortune on the backs of Americans who lost their homes. Tonight, those homeowners speak out to CNN. Drew Griffin is out front.
LeRon Lee and his wife Vicki spent 22 years in their California home, a home he'd purchased after an 8-year career as a Major League Baseball player. Suddenly, he says, the mortgage was adjusted and their payments shot up.
We were paying like $3,000 something a month, and comfortably. The next statement showed $8,700 something, nearly $9,000.
When he couldn't keep up those payments, he tried to get a loan modification through the government's federal program aimed at saving people from foreclosure. His bank had been bought by One West, owned by Trump's Treasury nominee, Steve Mnuchin, and his partners.
We contacted them that was seriously, we need the modification. And they said that we don't qualify because we have never missed the payment.
So okay, I'll do that. So we skipped the 2 months.
One West denies it gave that advice to customers, but lawsuits filed against the banks.
So think about this now. So Obama and the Obama administration, they passed programs like HAMP that is basically meant to help people refinance and basically get better rates on their mortgages. What banks like One West Bank, Wells Fargo, etc., they're going to tell these people that they don't qualify because they've never missed a payment. So what they need to do is miss a few payments so they can qualify. So they end up missing a few payments and then end up in foreclosure by listening to what the bank said. And you're going to see that in a second. This is madness. This is madness.
Say there was a repeated pattern. A number of One West customers say the bank told them to stop paying their mortgage for at least 2 months so they could qualify for federal help. Help that didn't materialize. U.S. Treasury officials tell CNN there was no requirement to stop paying mortgages in order to qualify for assistance. Nicholas and Eloise Palumbo say it happened to them too, though they admit they didn't manage their money well and got in over their heads after their mortgage ballooned.
I told them that we need help, and we were thousands of dollars behind.
They say One West told them to stop paying their mortgage. Then they failed to qualify for federal loan relief and lost their home. When Donald Trump nominated his Treasury Secretary, he said that Steve Mnuchin had run his bank very professionally. But a source close to One West's loan modification office says the bank was overwhelmed with just too many home loans underwater. The loan modification office was disorganized and swamped with work. Bank employees were getting confusing and differing sets of instructions from executives above. And as a result, homeowners suffered. The Palumbos found that out firsthand when they got 2 letters from One West Bank on the very same day. The first telling them the bank was still conducting a review of their home loan modification request. The second letter telling them their home had already been sold at a foreclosure sale 2 weeks before.
It's just bringing back.
So they're receiving multiple letters from the bank. One is saying that they're foreclosed. The other one is saying that it was under review. This just highlights the level of incompetence that we've seen with the banks. And it was laughable to even hear Bloomberg say that somehow poor people caused this to happen. Because again, this goes back to banks. There is something known as a debt to income ratio. There are certain mechanisms put into place to not loan people money like this. These people should have never been able to borrow this money in the first place. They should not have been able to borrow this money in the first place. They should not have been able to. They shouldn't have been able to get these mortgages in the first place. If you are subprime, they had no business loaning money to these people. And there's underwriting standards. Now, look, someone said right here, Jalen McKenzie saying it's incompetence from both sides. Right. And guys, I know that he's trolling. But what I'm going to do is I'm going to do this one more time. He's saying it's incompetence from both sides. There is no both sides. It's about incentives. If I know that I can get all of the benefit and get a small fine. It's known as moral hazard. If I can make $10 billion and I have to pay a $300 million fine, those banks are going to take those risks every single time. He says consumers should understand what they can and can't afford. No, you should not have a system that's based out of debt. You should not have a system that is burdening people with debt, that the only way the economy can grow is off of getting people into debt. That's the problem. It's the way that the entire system is structured, the way the entire economy is structured. It's structured to fail. It's designed to fail. Inflation is evil. It is wicked. And the government knows what they're doing because the government is the same people from the banking sector. As I just showed you, Hank Paulson worked at a bank at Goldman Sachs, and then he works in government. So there's not both sides. He is on both sides. He's making both sides. There isn't two. People make it like the government is a separate entity from the banks. The government is made up of people. These people go from private industry. They lobby and get the industry deregulated. And then they go and they work in the public sector and they get laws reversed and they get to sit there and see what's happening. And then they go back into the private sector. That's fraud. Period. That's fraud. There's no getting around it. That's fraud. It is designed to fail. It is known as the boom and bust cycle. Continental Illinois failed back in the 80s. We had the savings and loans crisis back in the 80s. We had First Penn Bank back in the 80s. We've seen this happen time and time and time and time again. What happens is the bailouts just get bigger and bigger because you know why? It goes back to this documentary. They're too big to fail. And you know what the too big to fail do? They just go and get bigger. And you get the boom and bust, the boom and bust over and over and over again. So when Bloomberg is blaming poor people, it's not poor people, it's the system. It's designed to fail. And this is where now, what did I talk about in the last video about good debt versus bad debt? Of having ratios, of knowing that I have 60% of my income that I'm going to live off of, and I have 40% of my net income that I'm either going to invest and save. And if I can't afford a home, then I can't afford a home. You do not get 74. Look at this debt chart. Look at this chart. Look at this chart of debt. Look at this chart of debt. $74 trillion. How do you get to $74 trillion of total debt if this economy isn't designed to put you in debt? Look how far the debt is outpacing the actual money in the system. And you tell me if this is, if you just read the fine print. Yes, you should read the fine print. Yes, you should have financial literacy. But this is how the economy expands and grows. Off of tricking people into getting into debt. So yes, personal responsibility does take a part, as I said earlier. But you still can't ignore the nature. The economy grows off of debt expansion. Money is debt. Money is debt. And when you understand that money is debt, you have to be very, 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 very careful with going into debt. You have to be very, very careful with that. You have to make sure that you take the time out and study and educate yourself so you don't fall victim to these predatory lending schemes. I broke this down for you guys the other day. How debt plays into the South Carolina Democratic primary. In the 20 minutes it takes for Reverend Brenda Lynn Neese to drive from her home in Columbia, South Carolina to her church about 15 miles north, she passes by at least 24 billboards and businesses offering payday loans. Lynn Neese says she's often approached at the church by people who've borrowed from these places, fallen deeply into debt, and are pleading for financial help. Predatory lending. Predatory lending. So let's get back to the good old Steve Mnuchin, right? And let's look at his net worth. Steve Mnuchin has a net worth of $300 million. How much of that $300 million you think actually came from all of this predatory lending. You have to be financially literate, especially as a black person, because they purposely target the fact that you're not financially literate to get you into bad auto loans, to get you into high interest rate auto loans, high interest rate credit cards. You have to pay attention and use your intelligence when making decisions.
Bad memories. It's just, what a shame.
Though Mnuchin's critics say his bank was far too aggressive with foreclosures, his defenders point to the fact that Treasury nominee took a failing bank and made it profitable again, potentially saving taxpayers hundreds of millions of dollars. And as for the claims of bad advice telling homeowners to stop paying their mortgages, Mnuchin's transition spokesperson told CNN literally every major financial institution involved in the mortgage business was accused of the same thing. That's why there was an independent foreclosure review, which One West was the only major bank to complete. The findings of the review showed an exemplary record and an extremely low error rate. Steve Mnuchin expects to discuss his successful record of modifying thousands of mortgages, saving people's homes and jobs at his hearing. As for LaRon and Vicki Lee, after a 4-year battle with One West, they did agree to a settlement and have kept their home.
Drew, Senate Democrats they're going to slam Steve Mnuchin about this, right? This is a Senate finance hearing. These are crucial questions. One of the labels they're going to try to put on him is the idea that he was a foreclosure king, right? He profited on the backs of regular Americans. Is that fair?
Aaron, you have to put this in context. Mnuchin in 2009 actually bought the remains of a bank called IndyMac off the federal government. IndyMac was in receivership. It failed. And the reason it failed, because it was one of the worst lenders. Subprime loans, loaning people money who, quite frankly, did not have the ability to pay it back. So Mnuchin takes this bank and all these toxic mortgages off the government's hands. He gets a great deal, yes, and then, though, is left to work through all these mortgages.
You heard what he said, and he gets a great deal. Let me tell you what the deal is. Let me break the deal down, how the government bailout works. When Henry Hank Paulson forced these banks to buy up the smaller banks, there was something in the fine print that most people missed. The government guaranteed the loans that would actually fail. So when they passed TARP and they passed TALF, there were certain parts of agreements. There were certain agreements made with these banks that Henry Paulson didn't put into certain programs because it would be a non-disclosable event. One of the sweeteners for the deals to get the banks to buy up these failing banks that had these toxic mortgages was that the government, outside of the FDIC, would insure and back up any mortgages that failed. So hell yeah, it was a sweet deal because it was a win-win no matter what. Him buying up IndyMac, he was going to win across the board. And someone put a who I think it was Patah Hotep. He said something, and I want to show you this. And I've broken this down time and time again, and I want to show you again. This is not complicated. This is how money is created. You don't need a PhD in finance to get this. Your government is borrowing money from a private institution by the name of the Federal Reserve. There is nothing federal about the Federal Reserve. And they don't have reserves. They create money out of thin air. Follow me here. This is not complicated. Which I'll tell you, go and read the book, The Creature from Jekyll Island. Simple. Your government needs $500 million. Okay. The Fed says, sure, no problem. They create what is known as T-bills. They send $500 million of T-bills to the Fed. And just like that, the Fed sends them $500 million. But here's the problem. This $500 million has interest attached to it. 1 second. Let me move this over. It's hard to write while my mic is on. They charge 3%. Even if you pay off the principal and you pay back this entire $500 million, how do you pay back the interest? How do you pay back the interest? You can't pay it back because they're creating your money. So that's the problem with the system. It's the way it's designed. It's designed and structured to keep you in debt. It's designed to keep America in debt. That's how it is. This is not. You don't need a PhD in finance. You don't need to understand all of the math that goes into the CDOs. Look at the national debt. Right? You can never pay back the interest on the debt because the money's being created out of thin air. So even if you pay back the principal, you can't pay back the debt. Now let's flip it over. Look at the debt clock. It just keeps ticking. When we delinked from the gold standard, it changed everything. The name of the book is The Creature from Jekyll Island, and I'm going to talk about it. This is what happens when you have Keynesian economists and you have a debt-based economy. The economy cannot grow without debt because debt is money. It's not complicated at all. Not complicated. Now, let's read this. Zoom in a little bit for you guys. So, Steve Mnuchin, he went to the Senate Finance Committee and he lied. And I'm going to read a little bit of this article for you. It says Treasury Secretary nominee. This is when he was being nominated at the time. He was a nominee to be the Treasury Secretary. It says Steve Mnuchin lied in his written response to the Senate Finance Committee, claiming that One West Bank did not robo-sign documents when ample evidence proves that they did. Mnuchin ran One West Bank from 2009 to 2015 in a manner so ruthless to mortgage holders that he has been dubbed the foreclosure king by his critics. The robo-signing scandal involved mortgage companies having their employees falsely sign hundreds of affidavits per week attesting that they had reviewed and verified all of the business records associated with the foreclosure, when in fact they never read through the material and they just blindly signed off. Those records in many cases were prepared improperly, but the foreclosures went ahead anyway because of the fraudulent affidavits. Right here. Did One West robo-sign documents relating to foreclosures and evictions? Senator Bob Casey, a Democrat from Pennsylvania, asked Mnuchin as a question for the record. Mnuchin replied that One West Bank did not robo-sign documents, and as the only bank to successfully complete the independent foreclosure review required by federal banking regulators to investigate allegations of robo-signing, I am proud of our institution's extremely low error rate. Think about that. It says, but even that review, which was not really so independent, since the banks handpicked and paid for their own reviewers, found that nearly 6% of One West foreclosures examined were not conducted properly. So I don't sit up here and guess when I'm speaking. How can you allow the people who are committing fraud to investigate themselves? To review themselves, the very people who sat there. And see, this goes back to the regulating industry, the regulators. This goes back to the derivatives market. Because when they take your mortgage and they create a security out of your mortgage, the rating agencies were rating it as AAA. They were marking the bank's mortgage-backed securities and the CDOs and the CDO squared, all of these crazy derivative products that had all of these subprime mortgages in it, they were marking it as AAA credit rating. And it was filled up with nothing but subprime loans. When you really sit down and you think about that, this is fraud to the highest degree. So when Bloomberg, go back to this, after everything I've just presented to you, and guys, we could sit up here for hours. I can get so technical and so just laser sharp, but I don't want to do that because we'll be here for 3 hours. I like to plant seeds and let you go behind me and you fact check this. And someone wrote, is the debt clock window dressing, or is it much worse than we've led to believe? It's much worse, because when you think about the derivatives bubble, there's so much debt, and there's so much paper in front of that debt, and there's not enough collateral behind the debt. See, that's why AIG started to fail, because AIG was insuring these mortgages, these mortgage-backed securities, and these derivatives and these CDOs for when they failed. So when they begin to start failing, and the banks needed to actually get the insurance money from AIG, they didn't have the money to pay because there was no collateral behind what they were insuring. Because as I said to you before, most of these banks and insurance companies, they don't have any reserves. They created out of thin air. Because it's a Ponzi scheme. They're banking on the economy's not going to go that bad. Things are not going to get that bad. And if it does, the Fed can just print more money. The Fed didn't even know how bad it was.
The world is thinking.
You've made some reference to the elements that led to where we are today. Could you go a little bit deeper and tell us from your perspective, how did we get here? What are the root causes of the crisis?
You can go back. I would say it probably all started back when there was a lot of pressure on banks to make loans to everyone. Redlining, if you remember, was the term where banks took whole neighborhoods and said, people in these neighborhoods are poor, they're not going to be able to pay off their mortgages, tell them your salesmen don't go into those areas. And then Congress got involved, as local elected officials as well, and said, oh, that's not fair, these people should be able to get credit. And once you started pushing in that direction, banks started making more and more loans where the credit of the person buying the house wasn't as good as you would like. Now, it's not so bad when the market for houses keeps going up, because the nice thing about making a mortgage loan is it's very secure. After all, if the borrower defaults, you simply sell the house and you have something that's worth more than the value of the mortgage. That assumes that real estate prices never go down, and we just discovered that they could. The way a bank works in making mortgages, it's exactly the same way as an insurance company works. You assume that a handful of people will default, but most people won't, and you share the pain with other mortgage issuers, so that if a big house goes under, you only have a part of it. What insurance companies never assume never will happen is plague, where everybody dies. And what mortgage bankers assume will never happen is a downturn where everybody wants to sell their house. And
see, so he's doing what is known as doublespeak, right? He's speaking out of both sides of his mouth, because he's saying that, well, they never assume that all of these things are going to happen. Also, what people never assumed is that many of these banks and these insurance companies didn't have enough reserves to meet these obligations when they were called, which became the problem. That's what the problem is. They just kept rehypothecating this over and over and over again throughout the system. And that's the problem. It's fraud. You don't have to be complicated. You don't have to complicate this. This is not complicated. There's 241 of you viewing this, guys. Like the video. It helps get the content out there. So when Bloomberg says that poor people made this happen, the poor people should have never been able to get a loan in the first place. You know why the banks did this? Because of the fees that they could charge off of originating these mortgages, or for being able to sell these and create derivatives in the market, so investors can then invest in this and they can make more money. That's what it was about. It was about greed and fraud. They just didn't think that everyone else was doing it. They thought that they were the only ones doing it. They didn't know that every single bank that you could think of that had the ability, that could invest in these products or create these products, were doing it. And they didn't think that the insurance companies didn't actually have the collateral. And as I said, the banks that were too big to fail, they just got bigger. So now, some of you keep saying, well, what's the solution, right? What's the solution? This goes back to crypto. This goes back to gold and silver, right? And the Bitcoin Genesis block, right? Bitcoin was created 11 years ago. And when people begin to realize the level of fraud that was in the system, people wanted something different. People want outside of the traditional banking system. People wanted a monetary system that's outside of the traditional banking sector, because it's happened in '08 and it's going to happen again. This is why gold and silver is important. In the Genesis block of Bitcoin, there is a message that's embedded inside of the Genesis block. And it says the Times 03, January 2009, the chancellor's on the brink of the second bailout for banks. That goes back to hard money like gold and silver. People want to have their wealth outside of the traditional banking sector. Because when you understand what's happening here, people want to be diversified. They want to be hedged. Now, again, I'm not telling you what you should put your money into. I'm not telling you what's going to make you rich. I'm talking to you about being diversified, as being hedged. That's where gold and silver comes into play, precious metals. That's where crypto comes into play, being hedged. Having something that's outside of the traditional banking sector. Because as you can see now with the whole thing that's happening with this virus, with the market selling off, everything's going down. Everything's going down. That's part of the problem. So, with that being said, guys, I'm going to look in the chat, see if there's any questions that I want to answer. How do you feel about the financial expert interview review that I suggested? The comment was in your last stock market video. I don't know exactly what you're talking about. They had negative amortization. People wanted to play this game. It's not about, it's that you can't keep saying people wanted to play this game. That's just dumb. That doesn't make any sense. You don't make subprime loans. You just don't do it. That's not smart. I worked in banking. I don't care where you worked at. That doesn't matter. That's bad. If you have a PhD in finance, you have a PhD in economics, you have a business that you're running, if the free market existed, people would never make these loans in the free market. You would never loan money to subprime people who couldn't pay and who had bad credit. Right? If you had a healthy functioning economy, if you had a sound functioning economy, if you had sound underwriting principles, you wouldn't do this. You do this because you know that the Fed is going to bail you out. That's why you do this, because the Fed has done this time and time again, because the government has done this time and time again. So do you recommend not getting a loan from a bank if you want to start a business? No, guys, I made this before. I meant to say, just know that way. Thank you for the donation, Mr. J. Guys, let me explain something to you. There's good debt and there's bad debt. You have to learn how to play within the game. You have to learn how to play with the rules in the game that you're playing. If you're playing football, right? You can't take a basketball and say, "Hey, I want to play with basketball rules." These are the rules to money, right? When you use your brain and you think for a second and you say to yourself, there's good debt and there's bad debt. There's debt that pays you and there's debt that you pay. If I understand the system, what I'm going to do is I'm going to get, this is just me, this is not financial advice. I want to get things that appreciate faster than inflation, or they cash flow. So the debt, I'm actually making more money on that debt. So if I get a multifamily unit and I put a tenant in the unit and the tenant is paying down the mortgage every single month and I can cash flow $300, $400, $500, $600, that doesn't matter, right? It doesn't matter. It's okay. I don't care about that, right? So you have to, it's all about having financial literacy. If you're taking out a loan for your for your business from a bank, you need to make sure that you can afford to pay back that loan, right? This goes back to being personally responsible, right? Being financially literate. I'm not going to borrow $300,000-$400,000 from the bank and I don't have a business that can support that type of debt burden. Right? It's about being financially literate. So yes, if you have a business and your business is making money and you have employees and you have revenue coming in, then there's nothing wrong with borrowing money. And there's nothing wrong with being responsible. Living off of 60%, putting 40% into your savings and investments. Right? It's called being responsible. Right? There's nothing wrong with borrowing money. There's something wrong with borrowing money when you're subprime. your credit score is below a 600, you don't have a job, you don't have income, you don't have assets, you have no business borrowing money. You borrow money when you have the ability to pay it back. It's called being financially responsible. Again, I'm not a guy who's just going to sit up here and just complain about the system all day long. You have to learn how to play within the rules of the game. The rules of the game states that debt is money. So when I'm creating debt, there's good debt and there's bad debt. Bad debt, getting a BMW and I only make $40,000 a year. I have no business driving a BMW if I make $40,000 a year, right? If I only make $60,000 a year and I have multiple children and I have student loan debt, I have no business going and trying to buy a home at this point. I need to be trying to get rid of my student loan debt. That's why it's called personal finance. And you have to find out what works for you and what doesn't work for you based upon your income level, based upon your debt levels, and based upon your goal. If I have a business that's thriving and I have customers and I have revenue, then yeah, I'm going to take out a loan. Right? Because I have other assets. See, like right now, the stock market's crashing. You don't see me panicking. Why? Because all my money's not in the stock market. I'm diversified. This is why diversification comes into play. This is where financial literacy comes into play. I have gold and silver. Right? I have crypto. Right? My Bitcoin, I'm well up over like 15x in my Bitcoin positions. Some of the coins I own is up almost 30x, right? So I'm diversified where if it's a pendulum. When something's overvalued, it swings to undervalued. When something's undervalued, it swings to overvalued. This is why you have to be diversified and you're looking to build wealth over time and understanding leverage. The problem is most people don't understand leverage or they become emotional. When you're running business or you're doing personal finance, right? You don't want to be emotional. Right? The American dream is not just owning a home. And the American dream is owning a home that you can afford. Let me say that again for you. The American dream isn't owning a home. It's owning a home that you can afford. And if you can't afford it, you don't buy it. Like the lady who had a 20% interest rate. There's no way in hell that I'm going to sign my name on a document where my mortgage is going to balloon from 7% to 20%. That doesn't make any sense. And here's another solution. If you're a person and you're like, you know what, listen, I don't have time for none of this. This is all a scam to me. I don't want nothing to do with it. There's nothing wrong with just sitting out. There's nothing wrong with saying, you know what, I'm going to just focus on my family and taking care of the things that I need to take care of. That's it. Some people don't want to participate in the game. And it's nothing wrong with that. Again, it's called personal finance. It's going to be different and tailored differently for different people, depending on what your needs are, right? Some people, they can manage a lot of debt with no problem. They understand bankruptcy laws. They have entities set up where they can write the debt off, right? It's all about sitting down with an accountant, sitting down with an attorney, looking at your debt to income ratio, looking at your expenses, looking at what's your cash flow that's coming in versus what's going out. It's all about personal finance. We're sent through K-12 with little to no financial education. Exactly. There will definitely be a class action lawsuit against Robinhood. What's going on with Robinhood? Let me see what's going on. Makes sense. I could not pull any money today from Robinhood or sell or trade. That could be for multiple reasons. I don't know exactly why that is. I'll look into it for you to see what's going on. SBA has lower rates for startups depending on the type of business. USDA. Yeah. There's a bunch of different mechanisms and things into play. You just have to be financially literate and make sure that you're doing the right things. Excuse me. There will definitely be a class action lawsuit against Robinhood, Mark J said. Thank you for the donation, Mr. J. Says, love the channel and appreciate the research and info. You give more useful information than Dr. Watkins with his finance PhD. Yeah, but you have to understand what Dr. Watkins is doing. Boyce is a capitalist. Boyce is here to make money. And I'm not knocking him. I'm not here to bash him. Boyce's thing is he feels that why teach for free when I can make money to do so, and I can create products and services to teach you the information, which is okay. That's how he wants to conduct things. But me, I have a bigger vision, and I have a different way I want to go about things. So I don't have to be money hungry to oversell products and information that you can get for free online, right? You know, so you have to just understand that that's how a lot of these people are on YouTube. Like, they create these products and services where they want to make money, and that's the beautiful thing about, you know, capitalism and being a free market. You know, depending on, you may like Boyce better than me. You may think that Boyce is more intelligent. He may have more credentials. He may be better spoken than I am, and you may want to spend your money with him and buy $1,000 product, or you may want to come here and, you know, listen to me talk for an hour and a half. It all depends on, you know, who you're going with and what you're looking for. You know, I've listened to Boyce and I don't find any value in Boyce. That's just me personally. There's no attack on him. I'm not hating on him. I just, you know, to me, Boyce isn't that bright. He isn't that intelligent, or he's just playing the role of a fool. One of the three. But I just don't, you know, Boyce Watkins isn't for me. So thank you for the donation. Thank you for the donation. Appreciate it. You know, not only that, Boyce just goes on these tangents where he starts talking about, you know, things that just don't have anything to do with what we're talking about. You know, people need to know about the Federal Reserve. People need to understand fractional reserve banking. People need to understand predatory lending practices. People need to understand how to pull up a mortgage calculator like this. And when you're sitting there with that bank, you know, with the banker or that mortgage broker, and he's talking to you about your interest rates and all that, you need to know what the hell you're signing up for, and just pull out a little calculator like this and say to yourself, 20% on $65,000, that's insane. To pay $1,135 is insane. So Robinhood pulling a Coinbase, can't sell your stocks. Yeah. When it comes to investing, I like a multiple of different people. I like, when it comes to real estate, I prefer people like Meet Kevin. I like people who actually have skin in the game. I don't want a person talking to me about cryptocurrencies if they don't own any crypto. I don't want a person talking to me about real estate if they don't own real estate. I don't want someone trying to teach me about stocks if they don't actually own stocks the way that I want to own them. Like, some people are traders, so they're coming from a trading perspective. And then some people are investors, where like they're investing and they have different, you know, a different thought process as to what they get into and what they get out of. So like I said before, I like Meet Kevin when it comes to real estate. When it comes to cryptocurrencies and I want to learn, I like people like Andreas Antonopoulos, even Ivan on Tech, although he blocked me on Twitter because I called him out. He's a shill a little bit, and most people are. They're always trying to sell you something, but that's who I like. I like Ivan on Tech when it comes to like crypto stuff. I love Andreas Antonopoulos. When it comes to economics, I like Jim Grant. I like Noria Rabini, and I like Peter Schiff. When it comes to economics, especially when it comes to investing in precious metals. And also I like Mike Maloney. Mike Maloney is really good when it comes to precious metals investing. I'll be honest, I didn't learn about finances until I was 20. I watched my mother go from pawn shops to title loans. Yeah. That's the case with most of us, guys. I didn't learn any of this stuff until I learned through trial and error, and then I happened to find a mentor, which actually helped me out. But I struggled for a while until I found a mentor and a person to point me in the right direction. But as I said before, I'm in the process of researching, learning, creating content, getting better at what I'm doing. And that's what I plan on in the next 3 to 6 months to create better content for you and to be that voice that can give you, good financial commentary and good financial information. And that's what I aim to become. And, I feel that I'm getting better, and I feel like in the next 3 to 6 months, I'll be even better, and my broadcast will be better. My video production will be better, and we'll go from there. But, it's a learning curve. But people like Boyce, they have platforms like the Breakfast Club backing them. So it's easy for him to get his information out there. Like, I had to start from zero. No one co-signed me. No one's promoted me, my channels and stuff like that. Like, I've literally built this up all on my own. So it takes time. When it comes to investing, it says Boyce Watkins is a mumble rapper. He wishes he invented ADOS. He wishes he invented everything. Yeah. I'll be honest, I read that one already. Who the hell would get a loan at 21%? That's almost a loan shark. Exactly. Yeah, I plan on creating like a Patreon and stuff like that. And thank you, Zulu Immortal, for hitting a like. I plan on either making a membership site or a PayPal. I mean, not PayPal, a Patreon for the crypto information, because YouTube, they don't like you talking about cryptocurrencies because it's an unregulated market. So a lot of like crypto YouTubers, their channels have been getting strikes. Of investment apps that you use, when it comes to investing, you can use like an E-Trade or you can use a Thinkorswim. I prefer Thinkorswim. That's what I like. I like Thinkorswim personally. I exited. I wasn't an investment banker. I worked in an investment bank. I wasn't an investment banker. I worked on the domestic equities trading desk. I worked at an investment bank, and the industry has changed. The industry isn't the same as far as leverage is concerned and the ability to be able to make money. What happened with the Fed is that they arbed out most of the trading opportunities, and this is why so many hedge funds have been struggling to beat the market, because there just wasn't any volatility in the market. So there wasn't any real money to make. It was hard to reach bonuses and stuff like that, and I just felt that I'm not a person that's well suited working for someone. I'd rather work for myself. But I was working on a domestic equities desk, and I was just basically trading stocks. But again, it just the arb wasn't there. The volatility wasn't there in stocks to really make money. So it didn't make sense to stay there. I didn't feel like I would be able to grow and really thrive and do the things that I wanted to do. So I went off and did my own thing. I started my own little fund, got a few investors from college who I played ball with, and met a few other people, and then that was that. Investing in your Patreon membership site would be worth 100% $10, $20. Yeah, it's going to be like $10 to $20. It's not going to be anything expensive. I don't believe in trying to price gouge people. I don't believe in trying to sell $1,000 boot camps and stuff like that. We live in an information age. Information should be cheap. It shouldn't be that expensive. And if you are charging $1,000, it should be plug and play. If I'm charging you $7,000, $10,000 for mentorship, I should be plugging you into a business that's going to be up and running and making you money. You're not having you pay $10,000 for some videos, some YouTube videos or some Vimeo videos. That's crazy. I learned personal finance from Dave Ramsey, and I have a college degree. Also, his lessons are simply but things I should have down 10 years ago. Yeah, I like Dave Ramsey too. But Dave Ramsey's he's not a fan of debt. And see, that's the thing, guys. You have to really learn how to take everyone's style and blend it to make it your own. I'm glad you said that, Alexander Wilson. That goes back to financial literacy, right, guys? You have to find what works for you. Like, I like crypto. You may not like crypto. You may be into penny stocks. You may be into cash flow and real estate. You may be into fix and flips. There are so many different things that people may be into when it comes to investing, right? You have to find what's going to work for you. So for some of you, it's just working and putting money in your 401k. And there's nothing wrong with that. See, what people have to understand is that money is something where it's a tool, right? And for different people, they may want to have different tools. You don't have to be Mr. I want to be investing in everything. You could just be a guy who I just want to have 3 or 4 rental properties and call it a day. Other people, they may want to get into trading. You may be a person who's into marketing, email marketing, social media marketing, whatever the case may be. You have to find your lane. And you only find that by going out and through trial and error and trying different things and finding what works for you. Some people crypto may be your thing. Stocks may be your things. Bonds may be your things. Commodities, precious metals, writing a book. You have to find your voice. Or, like I said, nothing. Just being better financially literate, saving more money may be the thing for you, right? Trying to save 10% more of your income. Humble Kurt said, thank you for your time, family. Keep delivering on a high level. Hit that like button. Thank you. Yeah, guys, please hit that like button. Has Boyce gone to court yet for the $10 million lawsuit against him? I don't know. I haven't really been following Boyce or any of those individuals. I really only been following like Umar and Polite, honestly. Do you like your market in NYC for real estate as far as rental properties? No, I would never buy a rental property in New York City. The taxes are way too high. The taxes just doesn't make any sense at all. How do you decide what you liked? Did you always know what you wanted to invest in, or was it trial and error? That's a good question. I seen a documentary when I was in college, right? It was a show called Wall Street Warriors, and I'll pull it up for you right now. And that's when I first fell in love with trading and investing. You have to understand that give me 1 second, I'll pull it up for you and I'll show you Wall Street Warriors. I was a freshman in college at the time when this documentary came out, this miniseries, whatever it is, like a miniseries. And I remember, I think was I in my sophomore year or my freshman year? I think this was my sophomore year in college. I remember sitting in my dorm room and I came across Wall Street Warriors. And I was watching, and then it had Timothy Sykes on there and some other people. And I just fell in love with the markets because I didn't understand. You have to understand, most of my life I grew up playing basketball, right? I wasn't into like business, economics, and life. I was really just into chasing my dreams because I thought I was going to go to the NBA. And then when the recession hit in 2008, I never had an idea what the hell a recession was. So many people were freaking out. We were losing so many jobs. I started really getting into this type of information. And I came across this right here. And I knew for the minute I seen this, I said, I want to be on Wall Street. From my sophomore year in college, I knew where I wanted to go. So I started out trying to do network marketing, most pyramid schemes, selling stuff. And I had some success in that. But that ended up, the company I was with ended up like getting fined and turned out to have like some elements of a scam. Then I tried to do a little bit of real estate. Then I got back into affiliate marketing. Then I got into day trading. Then I got into Forex trading. I didn't like Forex. Then I tried a little bit of options. Didn't like options. Then I got into stocks. Then I went and worked at the bank. And then I went and started my own thing. But I've tried different things. But I always knew I liked investing. I loved the stock market. And that's why I found what I wanted to do. No, trust me, the taxes are high, man. Taxes are high. I didn't say that they were the highest, but they're high in New York. Taxes are very, very high in New York. Very, very high in New York. So I have to disagree with you on that one, Mark J. It may not be the highest in the country, but goddamn it is high. I can tell you that for a fact. New York City, not even just New York City, just even in like Westchester, the taxes are high. I'll pay you to teach me how to trade. I don't trade crypto. I invest in crypto. There's not enough liquidity in certain markets to trade crypto. So like certain crypto projects, I buy and hold. Like I made a ton of money on like Ripple, Neo, like just by like following pump and dump Telegram groups. But that's back in like 2017, 2016 when the market started to explode. But PB&G, I hope that helps you out about finding what you like just trial and error, honestly. Now there's too much volatility in the market, which is beneficial for short sellers. Not sure how long it will last. Yeah. The Richest Man in Babylon by George S. Clason. Read it. As in the will say, if you pay up and lose your bread in the market, don't get upset. Yeah, it doesn't make sense to trade crypto. That story about saving dough and sleeping in your whip for a year hit different. Talk about sacrifice. Yeah, you have to know what you want to do. Do you plan to disclose what your mentor is at any time? Who your mentor is at any time? No, my mentor is not. He doesn't charge money, guys. I'm glad you said that. So my throat is getting dry. Most people who are like rich, they don't want to work with people and mentor people, honestly. Right? Me and him, we built a relationship because we was in the same network marketing company, and we just hit it off from there. And I was getting him a lot of sales, and I was just curious. And then over time, we built a relationship. It wasn't like I paid him for his mentorship. It was really just a matter of we built a relationship, and he would teach me things here or there. But I also learned a lot through trial and error. Like I had a person who steered me in the right direction, but I still had to go out and fish. And that's what I try to do with these videos. I try to give you a template of a way to think and how to frame things. And as I said, it's for you to go out and find what works for you. Right? It's like sports, right? When you look at athletes, Steph Curry is a different player than LeBron James. Giannis is a different player than James Harden. They're both pros. They just play the game differently. You have to find what works for you. As I said before, it may be real estate, it may be cash flow. It may be fix and flips. It may be, creative financing. That may be the thing for you. You may get into interior decorating. You may get into stock. Some people, they're beasts when it comes to options. They beast at selling premium. Some people, they're beasts at short selling. They know how to go and find which companies are in trouble. Some people are good at marketing. Some people are good at affiliate marketing, writing ad copy. You have to really find things that work for you. And that's why I'm a big fan of you. When you're first starting, you should not be investing no $7,500 into no mentorship. When you first start as an entrepreneur, you should be investing in education, affordable education. To find out what you like is what you should be doing, taking the time out to find what you like. And then once you find something that you like and you have a little bit of experience, then you could potentially go out and find a mentor, because no one's going to want to teach you the basics like ABC, like a stock or what's shorting. Those are the type of things that you can look up on your own, self-education. And then after you get some experience and you start making some money, then you can go get you a mentor or someone that actually knows how to get to the big money. Take your time. You got me into precious metals and I love it. I want to be in this for a minute. Fact check. NYC has low taxes. New York State areas like Westchester County. Yeah, well, I'm talking about Westchester. That's what I was talking about. I was talking about places like Westchester, Long Island, etc. New York City it doesn't have the cash flow in New York City. The prices are too high. I was talking about multifamilies in places like Westchester. That's exactly what I was talking about. Oh, Mark J. So take the American dollar. Should have been more specific about that. Alexander Wilson, is it worth it to put 3% down on a house? It all depends on what your strategy is. It all depends on your strategy. Again, that's why it's called personal finance. What are you trying to do with that home? Are you trying to just, suck the equity out of the home? Are you looking to try to get some appreciation quick and, suck the equity out where you do a little bit of renovations? You put like 20, 30,000 into it and then you try to refi and get the equity out. I mean, it just depends on your strategy. Can it cash flow enough to carry the mortgage? I don't think by putting 3% down that it's going to be able to cash flow enough to cover the mortgage and the taxes and the insurance. So I wouldn't do that, But again, it all depends. Is the neighborhood going through gentrification and you're going to see a lot of appreciation over the next coming years that's going to be able to overcome and offset the mortgage? It all depends on that. But like In the World said, 3% FHA loan, you have to be careful with that because you're going to have to pay the PMI, private mortgage insurance, until you get to 20% of the loan. So in my personal opinion, I would never really try to do a 3% loan unless I had an exit strategy. Like I would try to put a little bit more skin into the game. But I know people who do that, who play that game. And as long as prices keep going up, then you'll be fine. Fact check it. NYC has low taxes. Mark, I read that already. Put down what Wilson. Take the American dollar, invest in Africa. It's going to look bad in the coming years. Places like Africa, India, and I think Brazil, like the emerging markets, they offer the most opportunity. All the white people are the oh, okay, yeah, I gotta block you, man. You go. I can't have that in my chat. Sorry, Wakanda agent, but I have to get rid of you. You can't talk like that in my chat. That'll get my videos flagged. Are you excited about the Internet 2.0 decentralization and Ethereum, blockchain, smart contracts, and immutable ledgers? Say goodbye to the middleman and cruel censorship. Yeah, but that's what got me into crypto. Just understanding the potential to give people an alternative. For so long, people were stuck in the Federal Reserve System. There were no alternatives to the dollar. Now we have an alternative with crypto, with Bitcoin, and that's the value proposition. And over time, a lot of you will start to see it. The difference between centralization versus decentralization. Centralized systems make it easy to commit fraud and force the fraud on people. And there's nothing you can do to stop it. You're stuck in the system. Things like Bitcoin allow you to get outside of that system. No. Again, it's all that goes back to personal finance, Charles Swain. And this will be the last question that I'll take. Charles Swain says, in your opinion, is there such thing as having too many individual stocks in your portfolio to watch? No, not necessarily. It really just depends on, do you understand what you're investing in? And what are you going to be your goals? It's again, personal finance. What exactly are you looking to? Now, you can have too many stocks that are correlated. But like, think about it. Like if all you own is tech stocks and something happens to the tech sector, well, you're going to be in trouble because you have too many stocks in the tech sector, unless you have like options and stuff like that to protect you, and to hedge out some of the risk and arb out some of the risk. But to me, a diversified portfolio looks like, owning some dividend paying stocks, owning some growth stocks like a Chipotle, like a Tesla, stocks that may not necessarily earn money or be profitable now, but they have a lot of growth potential, and then looking at, like, I own a lot of precious metals mining stocks that pay out dividends because I know that the dividends are going to allow me to sit in the stock. The dividends are pretty high while the rest of the market catches up and begins to get appreciation. No, it's nothing. It's just diversification. But to me, diversification isn't having all my money in the stock market, right? To me, diversification is having real estate, is having precious metals, is having crypto, and having stocks, like having a multiple of different things. So, but my thing is, like, if you have the finances, there's nothing wrong with that. It's personal financing. To me, if I can have 100 stocks, then I can have 100 stocks if you can afford it. So with that being said, guys, I'm going to leave the video here. Thank you guys for tuning in. I appreciate everyone who donated today. Thank you so much. It definitely helps free up my time. As far as Bloomberg is concerned, it's laughable to blame poor people when the banks knew what they were doing. There's internal emails where they were laughing at what they were doing as former employees who signed affidavits. They basically was just telling what happened and breaking down how they purposely went after black people for predatory loans. So if you just tuned in now, please go back and watch the beginning. With that being said, guys, please like the video, share the video, subscribe to the channel, and hit that notification bell. And also, please don't forget to join my mailing list. Have a blessed and beautiful night.